Hi, in this video, I'm going to spend some time talking about the yield curve, introduce the concept. What is a yield curve? What does it mean for fixed income investors? What yield curves exist around the world and how we can get information from bond prices that tells us about expected future returns for fixed income assets. A lot of the things that I'm going to talk about in this video are not at all intuitive. I'm going to do my very, very best to make it simple and explain it in simple language. And hopefully you find it helpful when you think about and hear about things like interest rates, yield curves, future returns for bonds, and things like that. So what I'm going to do is I'm going to share my screen with you here. And what I've got here is a very simple diagram. This is a simple yield curve. We'll say for today that it's the Canadian government bond yield curve. So first off, what is a yield curve? Basically, it's the plotting of similar bonds of differing maturities over a time horizon, showing you the interest rate or the yield that you can receive for owning a bond of that maturity. So generally, a healthy upward sloping yield curve indicates that an economy is in expansion mode and that you get a higher return for having your money locked up in fixed income for a longer period of time. That's generally what a healthy yield curve looks like. It's an upward sloping yield curve. And simply across the x-axis, you can see like a 1-year bond in this case is yielding just over 3%, whereas a 4-year bond in this case is yielding over 4%. So a bondholder demands a higher return for having their money held longer in a bond than somebody who's holding a shorter term bond. And so the yield curve can be observed every single day, and the yield curve is determined by the prices of the bonds on that yield curve. We don't know what the future shape of the yield curve will be, but we do know from today's yield curve what we can expect in terms of returns for bonds at different points on the yield curve. So if you're a bond fund investor, if you are the manager of that fund, you may look at that fund and say, or excuse me, you may look at that yield curve and say, there's certain bonds on this yield curve that I prefer to own over other bonds in the yield curve. And generally, the higher expected returns are found on areas of the yield curve that have higher positive slope. So in this case, there's a higher expected return kind of on this top part of the yield curve for holding longer dated bonds of longer maturities. So the bond fund manager might say, you know what, I'm going to choose to purchase, the 4-year bond because, relative to other spots in the yield curve, it's offering me, the highest yield. And I want to accept the risk that interest rates could change in the near term, and the expectation that because there's a higher yield at this end of the yield curve, I should realize a higher expected return over time. And so the bond fund manager purchases that 4-year Canadian government bond at a 4.5% yield. And what's generally been going on in bond markets over the past number of decades is that interest rates have generally been coming down, that not consistently always, but interest rates have been lowering. And so the second line that you see here, the green line, is the future yield curve. So let's see, 1 year out, that interest rates across the maturity spectrum, the x-axis, have started to fall. So that bond fund manager bought that 4-year bond a year ago. Now it's a 3-year bond, and it's yielding a little bit higher than the previous 3-year bond here. It's still yielding at somewhere 4.5%. Since the yield curve has fallen, that means that interest rates have fallen and bond prices have risen. So that bond fund manager, if he wanted to or she wanted to, they could sell that bond and they could realize a capital gain. And well, how does that work? Well, we talked about it in a previous example, but if interest rates have fallen, that means that this bond that's currently yielding for 3 years just around 4.5% would be a premium asset to own. All other bonds are trading or selling to reflect the new lower interest rate at the 3-year mark. So in order for this bond fund manager to part ways with this higher yielding bond, they're going to want a premium. And that premium is sort of this area here that would be represented as a capital gain. And so the bond fund manager, if they wanted to, if they saw that there was higher slope somewhere else on the yield curve, and they said, there's a better opportunity now for me to purchase another bond, maybe even in a different market, I'm going to take my capital gain. I'm going to put it in my pocket. I've also had some interest payments, some coupons that I've collected over the past year that I've held the bond. So they've seen a positive return for accepting that higher yield or that interest rate risk further out on that yield curve. And so these are the decisions that bond fund managers are making every single day inside of an active bond fund. And so hopefully that gives you a bit of context from what is a yield curve, what do the different spots in the yield curve indicate, and how how changes in interest rates across the yield curve impact bond prices, and how a bond manager can make money even if they're not holding those bonds to maturity. Over and above just getting their money back and the coupon payments, they can make money through capital gains. If the yield curve falls and their bonds are above that yield curve or yielding higher than the current interest rate, they can realize a capital gain by selling that bond. And so here's what a global fixed income portfolio has the opportunity to do is they can look at yield curves in lots and lots of different countries. So the bond funds that my clients are exposed to from Dimensional Fund Advisors, the fixed income team at Dimensional Fund Advisors is looking at 12 global yield curves. And every day they're observing those yield curves and looking at bonds plotted against that yield curve and trying to decide where they get the highest expected returns for owning those bonds on that yield curve. So going back to our previous example, that bond fund manager is looking for areas on the yield curve where they see a nice positive slope because it gives them opportunities for capital gains. And higher yield just means that they have higher expected future returns for holding those bonds. So if you're a bond fund manager and you're looking at where on each of these curves do I have the best sort of bang for my buck in terms of buying fixed income? Well, on your yield curve A, the most positive upward slope is sort of at this, maybe on the shorter end of the yield curve. On yield curve B, it's not in the short term, it's somewhere in the middle. They see this sort of positive, gentle slope where they see a really good opportunity to generate some positive expected returns from owning fixed income. In yield curve C, it's pretty flat out on the long end, but on the short end, there's some opportunity. And this reflects the Canadian fixed income yield curve, the Canadian government bond yield curve today. A lot of yield curves are kind of taking this shape. Short end is a little bit steeper, long end is quite flat, but you can still generate some positive returns on that yield curve because you see that positive slope here. Yield curve D, as you can see, it's downward. It's sort of downwardly sloping, which indicates, not a very healthy economy or healthy yield curve, that investors in that geography are expecting tough times ahead. So they may decide to target the very, very short end of that yield curve where yields are the highest. So these are the decisions that bond fund managers are making every day to try to generate positive expected returns inside of their fixed income portfolios. So the big takeaway here is, familiarizing you with what a yield curve is, how prices work for bonds, the impact of changing yields and the opportunities that creates for fixed income managers, and how expanding your exposure in your fixed income to a global opportunity set gives you higher possible returns in your fixed income portfolio. And so I hope this has been helpful. Yield curves and fixed income is not the easiest topic to relate and to understand. So I hope that the visuals helped a little bit. There's more links to videos on fixed income in the description below. If you like this video, give it a thumbs up, and I'll speak with you soon. Take care.